96% of traders fail. Because of this personality type, the risk-averse personality, read that again in your head. Because the personality most people think is ideal for trading is the exact one that quietly destroys accounts. The risk-averse personality, the careful one, the let me protect my capital one, the trader who hates drawdowns more than they love opportunity. And here's the crazy part. If you lined up 100 losing traders and asked them what went wrong, most of them would say the same thing. I was disciplined. I followed rules. I didn't gamble. And they'd be telling the truth. That's what makes this so dangerous. Because risk-averse traders don't blow up fast. They bleed out slowly. They exit winners early, hold losers just long enough to hope, and hesitate every time size actually matters. They're not emotional on the outside. They're emotional on the inside. Every green candle feels like something to protect. Every red candle feels like a threat to identity. So they do what feels rational. They lock profits early. They avoid uncertainty. They wait for confirmation, and the market smiles and takes everything anyway. Because markets don't reward comfort. They reward asymmetry, small losses, occasional big wins. And a risk-averse brain hates that equation. It hates the feeling of being wrong. It hates sitting through open profit. It hates not knowing. So it rewrites the story. It calls fear patience. It calls hesitation discipline. It calls avoidance risk management. And the trader believes it until months go by, then years, and the equity curve looks exactly the same. Flat, or worse, quietly declining. What almost no one realizes is this. The market isn't testing your strategy first. It's testing your tolerance for emotional discomfort. And if your personality is wired to avoid discomfort at all costs, every decision you make feels safe and moves you further from profitability. Most traders never spot this pattern. They just feel stuck. They try new indicators, new timeframes, new mentors. But the same invisible hand keeps steering their trades into small wins, missed moves, and long-term failure. And once you see what that hand actually is, you can't unsee it. There's a specific moment in every profitable trade where most traders unknowingly sabotage themselves. It happens fast, quietly, and it feels completely logical. Price moves in your favor, not aggressively, not explosively, just enough to turn green. And right there, before strategy, before logic, before rules, relief shows up. Not confidence, not conviction. Relief. Your nervous system relaxes. Your shoulders drop. Your breathing changes. And the brain sends a single message. Don't mess this up. That's the moment the risk-averse personality takes control. Not with panic. With reason. This is a good spot to take profits. No one ever went broke locking gains. I can always re-enter. So the position gets closed. Not because the trade is over, but because discomfort is gone. And here's the part most traders miss. That relief you felt, that was the cost of admission to the real move. Because the trades that change equity curves never feel safe while they're happening. They feel exposed, unfinished, uncomfortable. The market doesn't release big profits early. It makes you sit through uncertainty to earn them. Now flip the situation. Price pulls back first. Nothing invalidated. Setup still intact. But now the brain doesn't feel relief. It feels threat, so it stalls. Let's wait. Let's see what it does. I'll enter on confirmation. And confirmation finally comes, right after the move is gone. So over time, a strange pattern emerges. You're rarely very wrong. You're just never very right. Losses stay controlled. Wins stay small. And it feels like progress until you realize something unsettling. The market keeps offering the same opportunities, and you keep responding the same way. Because this isn't a strategy problem. It's a comfort problem. Risk-averse traders don't lose money because they misread charts. They lose money because they instinctively escape the exact emotional states that profitability requires. Sitting in open profit without control, letting a trade breathe, allowing uncertainty to exist without interference. That's the tax. And every time you avoid paying it, the market charges you somewhere else. In missed runs, in capped upside, in years that feel busy but go nowhere. Most traders sense this deep down. They just don't want to admit that the thing holding them back isn't the market. It's the personality they've been relying on to protect them. And the moment you stop letting that personality drive decisions, everything about trading starts to feel different. Not easier, just clearer. Most traders think discipline means control. Control your emotions. Control your risk. Control your behavior. That belief alone keeps them trapped. Because the traders who actually make money aren't the ones who feel the least discomfort. They're the ones who don't obey it. Here's the illusion risk-averse traders live inside. If I feel uncomfortable, something must be wrong. So the moment discomfort appears, they intervene. They adjust stops. They take partials. They flatten positions. Not because the market told them to, but because their nervous system demanded relief. Profitable traders experience the same discomfort, same fear, same uncertainty, same urge to interfere. The difference is what they do next. They don't treat discomfort as a signal to act. They treat it as a signal to observe. They already decided what to do before the trade ever went on, before emotions entered the room. That's real discipline. Not emotional control, but decision pre-commitment. Risk-averse traders decide during the trade. Profitable traders decide before it. That one shift changes everything. Because when the urge to exit early appears, the profitable trader recognizes it instantly, not as wisdom, not as intuition, but as fear wearing a suit, and they let it talk, without handing it the steering wheel. This is why two traders can run the same strategy and get completely different results. One reacts to discomfort. The other allows it. One manages emotions. The other manages behavior. And here's the uncomfortable truth. If you need to feel calm to trade well, you will never trade well. Calm is a byproduct of certainty. Trading is built on uncertainty. The moment you stop trying to make trades feel safe, you start giving them room to work. That's when winners grow. That's when expectancy shows up. That's when trading stops feeling like survival. Most traders never make this transition. They keep polishing rules while letting their personality override them in real time. They stay disciplined and stuck. But once you understand that discipline isn't about avoiding discomfort, it's about functioning inside it. The market stops feeling random and starts feeling brutally honest. This is why so many traders plateau for years, not days, not months, years. They're not losing badly enough to quit, and they're not winning big enough to grow. They sit in the middle, where effort feels constant, but progress feels invisible. And risk-averse personalities end up here more than anyone else, because they're optimizing for not losing instead of optimizing for positive expectancy. They spend years perfecting entries, fine-tuning indicators, filtering trades. But the real bottleneck was never the setup. It was what they did after the entry. They never let winners do the heavy lifting. They never allowed the math to work. So the account becomes a mirror. Same emotions, same decisions, same results, over and over. And the market doesn't intervene. It doesn't warn you. It just keeps offering opportunity to see if you've changed. Most traders interpret this wrong. They think they need more certainty, more confirmation, more rules. But certainty is exactly what keeps them trapped. Because profitable trading requires acting before certainty appears, and holding after comfort disappears. That's the personality shift. Not becoming reckless, not increasing risk blindly, but learning to separate emotional discomfort from actual danger. One is necessary, the other is optional. Risk-averse traders treat them as the same thing. Profitable traders don't. They accept that discomfort is part of the edge, part of the cost, part of the business. And once that clicks, something subtle changes. Trades stop feeling personal. Drawdowns stop feeling threatening. Open profit stops demanding action. Not because emotions disappear, but because they're no longer in charge. That's when the plateau breaks. Not with a new system, not with a new mentor, but with a new relationship to discomfort. And once that relationship changes, the market starts paying you differently. Here's something almost no one talks about. Risk-averse traders don't just manage trades differently. They remember trades differently. After a losing trade, they replay it. After a small win, they justify it. After a missed runner, they rewrite it. They tell themselves, at least I made something. At least I didn't lose. At least I stayed disciplined. And slowly, the brain learns the wrong lesson. It learns that avoiding pain equals success. So the next trade starts already compromised. Size feels heavier than it should. Targets feel farther than they are. Every fluctuation feels meaningful, not because the market changed, but because memory trained fear. This is how a personality trait becomes a feedback loop. Fear drives decisions. Decisions create mediocre results. Mediocre results reinforce fear. And the trader mistakes familiarity for safety. They don't feel confident. They feel contained. That's why risk-averse traders often say, I just need consistency. But what they really mean is, I want outcomes that don't challenge me emotionally. The market never offers that deal. Consistency in trading doesn't come from smooth emotions. It comes from allowing uneven outcomes to play out over time. Which means some trades feel amazing, some feel awful, and most feel unresolved while they're happening. Risk-averse personalities try to flatten that experience. They compress the emotional range and accidentally compress the results. Because expectancy lives in the extremes, in the trades that feel too good to hold, and the trades that feel too uncomfortable to sit through. And every time you exit early to feel better, you train your brain to do it faster next time. That's why this problem doesn't fix itself. It compounds. Until one day you realize you've been trading for years, and your account looks like someone who just started. Same effort, same stress, same conversations, different calendar year, and that realization hits harder than any single loss ever could. At some point, risk-averse traders realize something feels off, so they try to fix it, not by changing themselves, but by changing their rules. They add more conditions, more filters, more confirmations, rules that sound intelligent, rules that look professional. But if you look closely, those rules have one thing in common. They're designed to protect comfort, not performance. Take profits quickly to reduce exposure. Wait for extra confirmation to avoid fake moves. Trade smaller until confidence returns. Each rule feels responsible. Each rule reduces emotional strain. And each rule quietly removes edge. Because edge lives in uncertainty, in incomplete information, in holding positions longer than feels reasonable. Risk-averse traders don't realize they're building systems that perfectly match their fear. The strategy becomes an extension of the personality. Safe entries, early exits, limited upside. And when results disappoint, they don't blame the rules. They blame themselves. I need more discipline. I need better execution. I need to trust the system. But the system was never built to win big. It was built to feel okay. That's why changing strategies doesn't help. New charts, new indicators, same behavior. Because the personality sneaks in through the rulebook. And here's the uncomfortable truth. If your rules always reduce stress, they're probably reducing expectancy. Profitable traders don't ask, how can I feel safer in this trade? They ask, how do I let this trade express its full potential? Those are very different questions. One leads to comfort, the other leads to growth. And the market doesn't care which one you prefer. It only pays the second. Most traders never notice this mismatch. They keep refining rules that perfectly protect them from the very experiences that would make them profitable. And over time, they become experts at surviving trades without ever mastering winning. Most risk-averse traders are waiting for something that never arrives. Confidence. They tell themselves, once I'm more confident, I'll hold winners longer. Once I trust myself more, I'll size up. Once this starts working, I'll stop hesitating. But confidence is not the cause. It's the after effect, and waiting for it first keeps traders trapped indefinitely. Because confidence in trading is built from evidence, not belief. And evidence only comes from behavior that feels uncomfortable at first. Risk-averse traders want confidence before discomfort. The market only offers confidence after it. So they wait. They wait for a smoother equity curve. They wait for more confirmation. They wait for fewer emotional reactions. But the irony is brutal. The very behaviors that would create confidence, holding through uncertainty, allowing trades to fluctuate, letting winners breathe, are the behaviors they're avoiding. So confidence never forms. Instead, something else grows. Self-trust erodes, not because they're reckless, but because they keep overriding their own plans. Every early exit sends a signal. I didn't trust this. Every hesitation reinforces, I'm not ready. And over time, the trader doesn't feel cautious. They feel fragile. That's why risk-averse traders often say, I don't feel like myself when I trade. Because trading keeps proving they don't trust their own decisions. Profitable traders reverse this loop. They don't wait to feel confident. They act in alignment despite discomfort. And after enough repetitions, confidence shows up quietly, not as excitement, not as bravado, but as familiarity. They've been uncomfortable before. They've survived it. They've seen what happens when they don't interfere. And that memory changes everything. Not instantly, not dramatically, but permanently. The risk-averse trader waits to feel ready. The profitable trader becomes ready by acting. That single inversion separates the people who stay stuck from the people who finally move forward. You'd think a big win would fix everything. A solid runner, a trade that actually works, a day where the account finally moves. But for risk-averse traders, that's often where things get worse. Because the win doesn't create confidence, it creates pressure. Pressure to not give it back. Pressure to protect the feeling. Pressure to be smart now. So the very next trade changes. Size gets smaller. Targets get closer. Stops get tighter, not consciously, instinctively. The win becomes something to defend instead of evidence to build on. And the trader tells themselves they're being responsible. Let me lock this in. I don't want to get sloppy. I'll slow down. But what they're really doing is anchoring to comfort again. The win didn't rewire the personality. It threatened it. Because now there's something to lose. And risk-averse traders are far more motivated by avoiding loss than by pursuing upside. So the system tightens, the behavior contracts, the edge shrinks. Over time, the pattern becomes obvious, but only in hindsight. Big wins don't lead to momentum. They lead to hesitation. The trader never builds a streak, never compounds confidence, never scales behavior. Each win resets them emotionally, instead of propelling them forward. That's why some traders can point to 1 or 2 great trades from years ago and say, I know I can do this. But they never do it consistently, because consistency doesn't come from proof. It comes from repetition under discomfort. And risk-averse personalities treat success the same way they treat risk, as something dangerous. So they protect it, shrink it, neutralize it, until it no longer matters. The market keeps offering opportunity to expand, and the trader keeps choosing to contract, not because they don't want success, but because success feels unstable. And that's a far more powerful force than most people realize. At some point, trading stops being about money. It becomes about who you believe you are. Risk-averse traders don't just see themselves as cautious. They see themselves as responsible, as smart, as someone who doesn't do stupid things. That identity worked everywhere else in life. School, career, relationships. So they bring it into trading, and trading quietly rejects it. Because the market doesn't reward being responsible. It rewards being statistically aligned. And that creates a deep internal conflict. Every time a trade requires you to hold longer than feels safe, your identity feels threatened. This isn't me. I'm not this kind of trader. I don't trade like that. So you exit. Not because the trade is wrong, but because staying would violate who you think you are. This is why so many traders say, I just can't pull the trigger. Or, I know what to do, but I don't do it. They think it's a discipline issue. It's not. It's an identity mismatch. They're trying to succeed in an environment that rewards behaviors their identity was built to avoid: uncertainty, exposure, temporary pain. So the brain protects the identity. It chooses exits that feel like me, decisions that preserve self-image, actions that maintain internal consistency, even when those actions cost money. That's why knowledge alone never fixes this. You can know exactly what to do and still not do it, because doing it would require becoming someone slightly different, not reckless, not aggressive. Just someone who can tolerate being uncomfortable without needing to resolve it immediately. And most traders never cross that line. They keep trying to improve execution while protecting the same identity, which is why nothing changes. The market isn't asking you to be smarter. It's asking you to be less attached, to feeling like the careful one. And until that attachment loosens, every trade becomes a negotiation between who you want to be and what the market actually pays for. Most people don't lose that negotiation once. They lose it thousands of times, quietly, one early exit at a time. The shift doesn't start with bigger risk. That's what most traders get wrong. They think becoming less risk-averse means trading larger size, taking wilder setups, or forcing confidence. That only creates panic. The real shift starts somewhere quieter. It starts with permission. Permission to feel uncomfortable without needing to fix it. Risk-averse traders don't struggle because they feel fear. Everyone feels fear. They struggle because they believe fear means something is wrong. So the moment fear appears, they interfere, exit, adjust, reduce. The identity shift begins when fear is allowed to exist without being obeyed, not fought, not suppressed, just noticed. That sounds small. It isn't, because for the first time, the trader isn't reacting. They're witnessing, and that creates a tiny gap between impulse and action. In that gap, something new becomes possible. The trade doesn't change. The setup doesn't change. The market doesn't change. The relationship to discomfort does. Instead of asking, how do I make this feel safer? The internal question becomes, how long can I let this remain unresolved? That's where growth actually happens. Not in bigger wins, not in higher accuracy, but in extended tolerance. The first time a trader holds 5 minutes longer than they normally would, nothing dramatic happens. No fireworks, no breakthrough, just tension. But something subtle registers. I didn't die. I didn't lose control. I didn't need to fix it. And that moment matters more than any single P&L outcome. Because identity doesn't change through insight. It changes through experience. That contradicts old beliefs. And risk-averse traders need repeated experiences where discomfort exists and nothing bad happens. That's how the nervous system rewires. Not by logic, not by motivation, but by exposure. Which is why most traders never change. They try to think their way out of fear instead of letting themselves sit inside it. And as long as discomfort feels dangerous, every trade will feel like something to escape. But once discomfort becomes familiar, not pleasant, just survivable, the personality loosens its grip. And for the first time, the trader isn't trading to feel okay. They're trading to let the edge play out. The way out of risk aversion isn't bravery. It's calibration. Most traders think discomfort comes in one size, overwhelming or nothing. So they either avoid it completely or force themselves into situations that overload their nervous system. Both fail. The traders who actually change do something far less dramatic. They introduce small, controlled discomfort on purpose, not to be bold, not to prove anything, but to retrain the brain. Instead of holding a winner forever, they hold it slightly longer. Instead of cutting the position at the first relief spike, they wait through one more candle. Instead of shrinking size after a win, they keep it the same. Nothing heroic, nothing reckless, just enough tension to challenge the old pattern. And here's what matters. The goal isn't profit, the goal is tolerance. Can you let price move without intervening? Can you sit with uncertainty without narrating it? Can you feel the urge to act and not act? Each time you do, the nervous system updates its definition of danger. Discomfort stops meaning threat. It starts meaning familiar, and familiar things lose power. That's how risk-averse personalities loosen, not by force, but by repetition. The market stays unpredictable. The outcomes stay uncertain. But you stop reacting the same way. Most traders never attempt this. They keep waiting for a mindset shift that magically removes fear. It doesn't exist. Fear fades only after it's proven unnecessary, again and again, and that proof only comes from staying in trades slightly longer than feels natural. That's the paradox. The safest way out of risk aversion is controlled exposure to exactly what you've been avoiding, not all at once, just enough to make the old pattern uncomfortable and the new one possible. And once that starts, trading doesn't suddenly feel easy, but it stops feeling impossible. Most traders think results change first, and mindset follows. It's backwards. What actually changes first is time spent in uncertainty. Risk-averse traders measure trades by outcome, profit or loss, green or red, but profitable traders measure something else entirely. Duration. How long they stayed in the trade without interfering. How long they allowed price to fluctuate without needing resolution. Because duration is where conditioning happens. Every extra minute spent in an unresolved trade is a vote against the old pattern. A vote that says, this isn't dangerous. I can handle this. And that vote compounds. That's why two traders can take identical trades and walk away with different futures. One exits at the first sign of relief. The other lets time do the work, not because they're braver, but because they've trained for it. Risk-averse traders don't lack knowledge. They lack exposure. They haven't spent enough time inside the emotional states that profitability requires. So every trade feels new. Every fluctuation feels important. Every decision feels urgent. Time removes that urgency. Not calendar time. Time inside trades. That's when decisions stop feeling dramatic. That's when charts stop feeling personal. That's when execution stops feeling forced. The market doesn't reward intelligence. It rewards adaptation. And adaptation only happens through repeated, tolerated exposure to uncertainty, which is why the market keeps doing the same thing. It offers opportunity. It applies pressure. It waits. And most traders escape, but a few stay, and staying, not predicting, is what eventually separates them. Risk-averse traders love the word patience. They wear it like a badge of honor. I'm patient. I wait for the right setup. I don't force trades, and that part is true. But there's a second kind of patience almost no one talks about. The patience after you're in, and that's where everything breaks. Because risk-averse traders are patient before entry, and impatient the moment risk becomes real. They'll wait hours for the perfect setup, then exit minutes after it goes green. They'll pass on 10 trades to avoid a loss, then panic as soon as uncertainty appears. That's not patience. That's selective tolerance. They're patient when nothing is at stake, impatient when emotions are involved. And the market exploits that perfectly. Because the hardest part of trading isn't waiting to get in, it's waiting without control. Waiting while price fluctuates. Waiting while profit is open but unrealized. Waiting while nothing confirms your decision. That's the patience that pays. And it feels completely different. It doesn't feel calm. It doesn't feel mature. It feels exposed. Risk-averse traders confuse patience with comfort. So the moment patience becomes uncomfortable, they abandon it. They tell themselves the trade gave enough. They rationalize the exit. They protect the feeling of being right. And again, nothing collapses. The account survives, which is why the behavior sticks. But over time, something subtle happens. Their patience only exists where it doesn't matter. and disappears where it does. Profitable traders flip this. They're aggressive in preparation, decisive in execution, and patient only where it counts. Inside the trade, inside uncertainty, inside the part that can't be controlled. That's not a personality trait. It's a trained response. And until patience moves, from before the trade to during the trade, risk-averse traders will keep wondering why doing everything right never seems to move the account. Risk-averse traders are obsessed with being right. Not loudly, not emotionally, quietly. They track win rate. They replay losses. They feel personally validated by accuracy. And that obsession shapes every decision. They pass on trades that might work because they want trades that should work. They tighten stops to avoid being wrong. They take profits early to lock correctness because being wrong feels like failure. But the market doesn't reward accuracy. It rewards payoff. A trader can be right 40% of the time and make a fortune. Another can be right 70% of the time and go nowhere. Risk-averse personalities hate that math because accuracy feels controllable. Payoff feels chaotic. So they engineer their trading to maximize how often they're right and accidentally destroy expectancy. Small wins feel good. Frequent wins feel validating. But those wins are capped. They never stretch, never breathe, never get the chance to matter. Losses, meanwhile, are emotionally amplified. Every loss feels like proof that something is wrong with the trade, or worse, with the trader. So the system adapts again. Fewer trades, tighter exits, safer behavior. The accuracy goes up. The account doesn't. And this is where many traders get stuck forever. They're good traders. They're rarely reckless. They're often right, but they're never paid because profitability lives where accuracy is uncomfortable, in holding trades that might come back, in letting winners run longer than feels deserved, in accepting that being wrong is part of being paid. Risk-averse traders want the market to confirm they're correct. Profitable traders let the market decide the payout. And those are very different relationships. One is built on validation. The other is built on acceptance. Until accuracy stops being the goal, every trade will be managed to protect ego instead of edge. And the market will keep exploiting that preference without ever saying a word. This is where risk-averse traders finally convince themselves they're not cut out for trading. Drawdowns, not massive ones, normal ones. 2 losses in a row. A week that goes nowhere. A strategy that works, then pauses. To the market, this is noise. To the risk-averse mind, it's a warning. Something must be wrong. So the trader reacts. They reduce size. They stop trading. They tweak rules midstream. Not because the edge disappeared, but because discomfort returned. And here's the mistake almost everyone makes. They treat drawdowns as feedback instead of variance. They think the market is speaking when it's just fluctuating. So they interrupt the process right before the edge has time to show itself. Every drawdown becomes a lesson, even when there is none. And over time, the brain learns something dangerous. Consistency means avoiding pain, so the trader never lets a system mature, never lets probability work, never experiences the upside of staying put. They survive every drawdown and escape every opportunity, which is why their account history looks strange. Very few deep losses, very few meaningful gains, just activity, effort, stagnation. Risk-averse traders don't fail because they can't handle loss. They fail because they can't handle temporary uncertainty. They want reassurance before continuation, proof before payoff. The market offers neither. It only offers distribution over time. And until drawdowns stop feeling like danger and start feeling like the cost of participation, every system will be abandoned right before it has a chance to work. That's the final trap. Not fear of losing money, but fear of not knowing yet. So when you hear that 96% of traders fail, understand this. It's not because they're reckless. It's not because they're stupid. It's not because they don't work hard enough. It's because most people bring a personality into trading that was rewarded everywhere else in life. Be careful. Avoid mistakes. Reduce risk. Protect what you have. In trading, that personality gets punished. Not immediately, quietly, through capped winners, missed expansions, interrupted edges. The market doesn't need you to be bold. It needs you to be tolerant. Tolerant of uncertainty. Tolerant of open profit. Tolerant of being wrong without needing resolution. That's why this failure rate never changes. Because personalities don't change easily. Most traders would rather look for a better setup than sit longer in discomfort. They would rather learn another indicator than relearn how they respond to fear. So they keep trading the same way, with different tools, and expect a different result. But once you see this, you realize something unsettling. The market was never against you. It was simply revealing what you instinctively avoid And the moment you stop trying to trade in a way that feels safe and start trading in a way that lets probability breathe, you're no longer playing the same game as the 96%. Not because you know more, but because you finally stopped letting comfort make your decisions. And that's the real edge.